Hi, this is Robert Peary, CEO and Chief Investment Officer with Bias, otherwise known as Bermuda Investment Advisory Services Limited, recording from our offices in Hamilton, Bermuda. It's March 3rd, 2010. With me are Brian Dooley, CFA, Senior Investment Strategist, who manages the Bias Global Portfolio Balance Fund, along with other portfolios, of course, and Kent Turner, also CFA, who manages the Bias Global Portfolio Equities Fund, also along with other portfolios. You know, we have a number of clients around the world who cannot attend our quarterly market briefings, so we thought it would be useful to record a roundtable discussion using the PowerPoint slides we prepared for the quarterly briefing. So we will get this to you by email or some other means that you have indicated you prefer. It is almost a year since March 9, 2009, when equities markets around the globe hit near-term lows. And since that time, those same markets have appreciated by over 60%. This is most encouraging for market participants, but we at Bias are still mindful of the challenges facing global markets in the coming year. First of all, we have a withdrawal of stimulus in both the major market of the world, the United States. The Fed is shrinking its balance sheet, basically deleveraging the economy, and China is paring back its expansion through raising higher reserve requirements in its banking system. At the same time, we have what is referred to as a crowding out effect of credit markets or bond markets. As the U.S. and other governments increase their debt load, they have to go into the marketplace to borrow, and of course this crowds out lending that may be required to fund various corporations and businesses around the world. Most worrisome is the stubbornly high unemployment rate, particularly in the U.S., but we think this is going to be coincident elsewhere, in that although we are seeing corporate profitability, it's going to be a long time off before that corporate profitability translates into improved employment. So, Brian, why don't you help us out here by discussing what has happened to date with respect to the U.S. stimulus, so we can see where we've been, and that should help us talk about where we're going from here.
As we can see on the chart, we have, and as you alluded to, we've had a huge expansion in the Federal Reserve's balance sheet. And what we're highlighting with our chart is that in past recessions, the Fed, whose charter is to stabilize the U.S. economy, in the past they have dropped interest rates when the economy went into a recession or the economy slowed down, making lending costs for businesses cheaper and thereby stimulating the economy. Of course, when the economy gets too strong, the Fed worries about inflation and they start to raise interest rates. And this is the typical Fed reaction. If we extended this chart back 30 years, that's how they've always reacted to downturns in the economy. They drop rates. When they get concerned about overheating, they raise rates. What's happened is this blue line which shows the size of the Fed balance sheet. So that's the amount of assets the Fed has on their balance sheet. And that's normally a very straight line like you see up until 2008. What you see at the end of 2008 is a huge increase, over a doubling in the size of the Federal Reserve's balance sheet. So the Fed is now going into the market and buying assets. They're buying mortgages, they're buying treasuries, they're buying all kinds of U.S. securities to keep the debt markets stable.
So Brian, by buying all these securities, what they're essentially doing is putting liquidity into the economy, and that allows greater spending, and hopefully will lift the economy, or at least keep it from falling to greater depths.
Yes, exactly. What they've done is keep interest rates low, and not just very short-term interest rates where banks tend to borrow, but longer rates where homeowners and mortgage holders tend to borrow. So this has gone a long way towards stabilizing the housing market. That's probably why we have actually seen some strength in the underlying housing market in the U.S.
So the Fed has added all this liquidity to the system. Let's talk about the other side of the balance sheet, where the U.S. government is having to borrow funds and creating this crowding out effect.
Yeah, and crowding out is a similar challenge, but I think it's a bit different in the sense that the U.S. is not the only one borrowing money out there. If you kind of look at it as if you're a lender right now and everybody in the world needs a loan, you can be very picky about who you're going to lend to and also your terms. And that's what's going on in the U.S. with this $3.5 trillion in new debt. At this point, the few lenders, which by the way are right now the U.S. savers, U.S. is saving through banks and through intermediaries such as mutual funds and foreign investors.
Of course, those foreign investors, the most leading foreign investors are actually China and Japan, and of course they tend to jump over each other in terms of being the largest lenders to the U.S. government. I haven't seen the statistics of the world at large, but I know that in the top 5, the Caribbean and Bermuda is included, which may be as a result of the many hedge funds based in Cayman, as well as the huge reinsurance sector based in Bermuda. So China and Japan have been big buyers, but we've seen recently China has been pulling back on its buying of U.S. treasuries. So that really exasperates the crowding out effect, doesn't it?
Yeah, exactly. We're again, China and Japan, especially Japan has its own recession going on. They're trying to mend the fence in Japan, and there's a question as to whether they can continue to buy as much as they have. And as you mentioned, China has already started to pull back, and there may be political reasons. Obviously, even though the U.S. and China need each other, there's a bit of a rift which seems to be growing at the moment.
So on the bright side is that the U.S. savings rate, which has been chronically low for generations, has actually moved up quite nicely during this recession and appears to have peaked at around 6.4%. But that's not quite enough to meet the needs of the U.S. government, is it?
Yeah, exactly. That's a great point. And we are encouraged for a lot of reasons. It's important for the U.S. to have a higher savings rate. And for this main reason is that there's more of a hope that we can fund ourselves instead of having to rely on these foreign investors. But you hit it on the head. If we peaked, as we think we may have in the fourth quarter, we're still talking only about a little over $500 billion in savings. And remember, we need to refinance over $3 trillion.
Right. So if you've got all these entities, in this case the U.S. government, needing to borrow, you've got companies that need to borrow, you've got other countries that are in deficit situations. The one making the biggest headlines right now is Greece. So what happens if you've got all these people looking to borrow and not as many players to invest? You're going to have higher interest rates, and that could threaten the recovery.
Yeah, absolutely. Greece is kind of in the microscope now. We all know that country has had a very difficult time getting their finances together, i.e. they're not balancing their budget. Right now, Greece is looking at a 13% debt to GDP, which is very high. The European Treaty, the Maastricht Treaty, actually advocates 10% less, a 3%. But if we go out a little bit farther, the U.S. is looking to run 10% GDP debt to GDP ratios themselves. So Greece right now is paying 3 points over German interest rates because of their problem, and we just wonder how long it is before some of these so-called more developed countries need to pay up, including the U.S.
Right. Now, I mentioned earlier that one of the worrisome things is the unemployment rate, which seems to have extended far beyond the time period that we've seen in recent decades. If you look at the next slide, we see that we're at a 4.7% increase since January 2008. You want to explain that, Brian?
Yeah, what we're looking at on this chart is not the absolute level of unemployment. We all know that that's almost 10%, 9.7 to be exact, as of the latest month. But that's an increase. So when the recession in the U.S. started, we had about a 5% unemployment rate. Now it's risen by 4.7%. On that chart, we compared it to historical recessions, the last 5 recessions, and we find that this is much higher in terms of the increase from going into the recession to the peak of unemployment.
So just to sum up on the employment side of things, I think this is probably the biggest challenge towards recovery, because if you use the U.S. as a proxy for the world at large, 60% of U.S. gross domestic product comes from consumption, consumption being what people spend. And of course, if you have a high, relentless unemployment rate, it's very difficult to get those consumption numbers up in the gross domestic product numbers. So talk to us about the global GDP forecast then, Brian.
Yeah, with all these challenges ahead, it's really hard for us to see let's call it a typical global economic recovery. Typically coming out of a recession, you experience a big surge in output. And we've actually seen some encouraging numbers out of the U.S. Fourth quarter GDP was 5.7% coming out of fourth quarter. However, if you look under the microscope, a lot of that was just inventory restocking, i.e. putting stuff back on the shelf, not that it was necessarily sold to the final customer. So our take is that we're going to see slower growth than we have, at least a third slower growth than we've seen historically. We think, as per the chart, the emerging markets will outgrow the developed world, the OECD. However, the OECD is really going to struggle. You can see that red line kind of rolling over. And even the most optimistic forecast, we're using the IMF, which tends to be a little rosy about things, is looking at maybe a little bit over 3%, over 2.4%, 2.4 versus a 3.3% historical average.
So look, it's going to be tough times in 2010. It's going to be a long, drawn-out recession. We're not necessarily looking for a double-dip recession, but we see the recovery being extended and very slow. We made a lot of money from our positions in emerging markets, particularly China and Brazil, and then following on from that, those markets that produce the hard commodities that are used for infrastructure buildup. That's a story that we've been playing on for about 3 years, and we've been increasingly aware that during tough times, businesses have to rethink the way that they run their businesses, and they have to rethink the way they sell their products. How do they get a consumer who's worried about being laid off or maybe already unemployed to spend money? We think that you have to create innovation. You have to create new products that get people excited. Although we are still very much keen on emerging markets, we think that most of the money has been made there near term, or at least the information that causes us to like emerging markets is fully priced into those holdings that we have in emerging markets. And so what we're now looking for and what we're scanning the markets for is evidence of innovation, because we believe that during tough times, as we're going through in this recession, that innovation comes to the forefront. Kent, you want to talk to us a bit about that?
Yeah, certainly. Thanks, Robert. I think what we're really talking about here, what we've narrowed it down to, because of course innovation can mean many things, but as Robert touched on, for businesses, it's all about creating new efficiencies. They've already trimmed down, especially on a staffing front, and now to increase sales and cut costs further, it's going to come down largely to new innovations, largely in technology. And then, as Robert mentioned, if you're going to get cash-strapped consumers in the door to buy your products, you're going to have to come up with some new, very exciting and innovative products. And so those are the areas we're focusing on. Specifically, we've really narrowed it down to 4 key themes. And the first one is, as touched on, innovative business spending. And this really comes down to, again, driving for new efficiencies within companies.
Right. So I think what's interesting about this theme is that it's not just going to be, it's going to be driven by technology, but you're not just going to find these innovations in the technology sector. It may be in the retailing sector. For instance, how somebody sells, and we'll get into that in a moment when we talk about our stock picks, but how they sell products and how they find that in the course of selling those products, they can generate other sources of revenues. But you want to talk a little bit more about the business side of things and what stocks we've decided to hold as a result of our expectation of increased innovation?
Certainly, and so as you said, it's not all technology, but that's certainly a big part of it. And so just let's start there. And because we expect companies to spend a lot more on technology going forward, we see this as a key part of our strategy, and we've been overweight technology for some time. The good thing about the tech sector also is that this spending that we expect to come from businesses, well, they can afford to do it. Unlike cash-strapped consumers and governments, which are heavily in debt, businesses have the cash on hand to upgrade their technology. So we've been overweight tech for some time. It's outperformed. A big part of that's from the software segment. Software is much less labor-intensive than the other sectors, huge profit margins. And recently, our latest investment is actually in the semiconductor space, or computer chips, where we've bought Intel. And Intel still controls 80% of the personal computer market, and we got this at amazing fundamentals. We bought it at 12 times earnings. Company has almost zero debt, just 4% debt to assets, and it kicks off a nice 3% dividend yield, which is rare for a quality tech company.
And of course, this is all in line with our notion of frustratingly persistent unemployment. Is that really businesses, rather than re-employing people as the economy recovers, are more likely to put that money into technology to improve efficiencies. That's unfortunate for those unemployed, but necessary for the survival of businesses and the recovery of the economy. Now, let's talk about the consumer side, because there's a lot of innovation and what I call convergence of various products in the consumer electronics side, and we really can't see to the extent these can converge, but there's a very, very fascinating dynamic taking place in consumer electronics.
That's right, and if you look at this slide and just the list of products listed here, most of you probably have several of these products and have most likely upgraded some of these products recently. You've probably bought a new phone in the last year. Most people have, because these things keep changing so fast. Most people now have, it's pretty standard to have a plasma or LCD TV or LED TV in their house. Most people have a Facebook account. And now when you go buy a computer, you can't just decide, well, I'm going to buy a PC or a laptop. Laptops now have been broken down. You have notebooks, which is basically a small laptop, a netbook, which is a ultra small laptop that you're really good for travel and just doing basic internet surfing. And the latest new gadgets are what they call tablets, which iPhone's trying to revolutionize this industry.
So the iPad, you mean?
That's right. The iPad, which is basically a product about the size of a book that you can surf the internet, watch movies, and just carry around with you in your handbag.
I think this is fascinating. I've got a tenant who's borrows my laptop in order to call his family and friends in India. And so you'll be seeing that if you have a convergence of the laptop, the BlackBerry, and the cell phone into one, you'll probably be communicating via VoIP. So talk to us about the smartphone revolution, because I think that's sort of, the smartphone is at the head of this convergence of technologies for consumers.
That's right, and so of all these tech gadgets, we feel like the smartphone market provides the one best opportunity that we've found. And just to explain what a smartphone is, many of you probably have one, but a smartphone is basically a cell phone or a mobile phone that has computer-like functionality. So you can, the key function, you can browse the internet. You can also send and receive emails, open files like pictures. It has some type of full keyboard functionality, either an actual keyboard on the phone like the traditional BlackBerries, or a new touchscreen format, which the iPhone really was the game changer there.
Now, we've seen huge growth in this market over 2009. I see that it was up 39%, the global market for smartphones, and that over 35% of mobile phones in the U.S. are indeed smartphones. And of course, Research in Motion, which is one of the stocks that you've purchased recently, is although created or invented for business use, is now becoming something that people will use for personal use.
That's right. What few people realize is that Research in Motion now generates over 50% of its sales from consumers. So while they still really, you could say, own the corporate market with 50% market share there, now they're really being aggressive on the consumer side as well.
Right. Okay, so now you bought this, I think, one of the, at a very good valuation, 12.5 times.
That's right.
Earnings. That's pretty cheap for a technology stock when you think about, during the tech bubble, we were looking, 30, 40 times for a cheap tech stock. Are you seeing this across the board with respect to tech stocks?
We're seeing several tech stocks that are at a bargain, and Intel, which we mentioned previously, was another one. But Research in Motion was basically, it fell off the radar because of all the hype about the new iPhone and Google's new Android software. And I think what people may have forgotten here, the global investors may have forgotten, is that this is a fast-growing market. We're talking 20 to 30, even 40% growth year over year for the smartphone market, and there's going to be 4 or 5 big players maintained, and we think RIM will be one of those top players for the years to come.
Let's talk about. Let's move on into the consumer electronics side more deeply. You bought how many weeks ago? Best Buy.
That's right.
Talk to us about that. I see you bought that 11.5 times earnings, so that was pretty cheap along the lines of the other tech-related stocks that we're buying. Of course, it is a retailer, but it's a retailer that is marketing consumer electronics.
That's right, and again, all with our innovation theme here. And Best Buy, of course, sells many innovative products, but that's not really what we're getting at here. What we're interested in is how Best Buy is using an innovative approach to sell its products and use its existing resources to gain further sales. One key thing that they're doing is using their market dominance and the direct contact they have with customers every day and seeing what customers like and don't like, going directly to their suppliers and influencing what products the suppliers make and how they make them.
Influence the manufacturing process. So that's an innovation. That's another form of innovation. It really comes down. Innovation is very, very reliant on processes and improving those processes. So that's quite fascinating. The other thing that I found amusing that I don't know why no one's thought of it before, but Best Buy has figured out that it may not be a major revenue provider, but every bit helps. They figured out that they've got some 50 televisions on display in any of their stores. Why not run ads on those televisions and get additional revenues? So I thought that was amusing and quite interesting.
Yeah, it seems like a no-brainer, but the first that I know of to do it.
So technology, certainly there's always going to be innovation in the technology sector. But Brian, we've been very keen on health care for quite a while. We've had generic drug maker Teva as one of our stock picks. But there's more innovation coming in there.
Yeah, absolutely. The one thing you can't argue with, no matter what government budgets look like and consumer budgets happen to be at the moment, we all need health care. And this is exacerbated by the fact that people are simply getting older. Because of medical technology, people are living longer. In fact, in the U.S., the fastest growing population are the people over 60 years old. There's just more of them every year. They need health care. And on top of that, they want a healthy lifestyle. So we are invested in companies that address these needs and do that in an innovative way, which gives them a solution and an efficient solution. We are very shy on the big, large cap pharmaceutical companies. We're not quite as concerned as we were a few months ago when the U.S. healthcare reform legislation was front and center. But still, for other reasons, we prefer companies that are into heart devices, i.e. pacemakers and stents, artificial limbs. That goes along with having a healthier lifestyle that OECD consumers are demanding, imaging, surgical equipment, and staples, just the basic nuts and bolts of what it takes to keep a patient in a hospital.
What's interesting is we're seeing that the market for advanced medical devices is growing at a pace of 7% annually, and as was mentioned earlier, GDP we're struggling to get over 2% annually going forward. So this is a high growth market.
Right, and in fact, I think the 3 best performing subcategories under healthcare have been generics, pharmaceuticals, advanced medical devices, and the third one is biotech. We've been in advanced medical devices and generic pharmaceuticals. Biotech is more complicated and it's easy to get burned in that sector, and until we have a better handle in that area, we're just going to stay shy of it. All right. Well, thank you very much for that rundown of of what we've been looking at, or what our outlook is for the markets. We're going to close and wish you well. And if you have any questions, please do not hesitate to email your account executive portfolio manager or give us a call. We're always happy to talk to you. And please let us know if this recording has been useful for you. We have lots of information. It's on our website, which is www.bias.bm, or for those of you in Cayman, www.bias.ky. You go into the client login site, put in bias as the login, and then clarity as the password, and you can find the full format of the quarterly market briefing, which we try to cram into about 30 minutes here. We would like to highlight the fact that the Bias Global Portfolios have got their first rating from Morningstar. Morningstar evaluates mutual funds and portfolio managers around the globe, and we got 4 stars out of 5. So we're very pleased to get that as our first ranking, and we hope you appreciate our efforts to provide you with the best risk-adjusted return that is possible in these very trying times. Thank you for now, and from Robert, Brian, and Kent, we wish you well over the next quarter.